Interest rates are rising and it's affecting real estate investors all over the nation right now. I personally have flipped over 600 homes over the years, and I also do a lot of BRRRR investing: buy, rehab, rent, refinance, repeat. There's a number of projects that I've purchased about 6 months ago that today I needed to refinance them, and rates have skyrocketed and it's affecting my deals today. Are they affecting your deals today? What do you do if rates have made it to where your BRRRR or even your rental or even your next flip is not looking so good of a deal? How do you manage that? What options do you have? I'm going to go over with you guys today a 3-bedroom property that I purchased a number of months ago, and when I went to go refinance it, when I went to go do my BRRRR, I failed at it. And what decision did I make and how did I overcome that? I'm going to show you guys before photos, I'm going to show you after photos, I'm going to show you all the numbers and how we took advantage of this market, but how the market also took advantage of me, and we're going to go over all of that right now. All right, so as I mentioned, the interest rates have gone up significantly. And if you guys were doing a BRRRR, buy, rehab, rent, refinance, repeat, a lot of you might have bought a deal a number of months ago, and then when you finally got a tenant in it and you go to refinance, you found the interest rate you were hoping to get is not the interest rate you're going to get. How do you handle that situation? Now, I want to show you guys a property that I bought. It's a 3-bedroom, 2-bath property in Spanaway, Washington, which is just next to Tacoma, Washington, an area I like to invest in a lot. Now, this property we bought a number of months ago, and when we bought it, we thought we were going to keep it as a BRRRR. We thought we were going to get an infinite BRRRR, which would be awesome. That's where you buy a crappy house, fix it all up, skyrocket the equity, and then refinance at a cash out refi, get all your invested money out of the deal, and still have it cash flow when you rent it out to a tenant, have no money into it, and have infinite return. Those are the best BRRRRs you can ever do. Are those still a reality today? I'm not sure they are. Let's find out what I had to do on this property here. So let's go to the photos. So this is a 3-bedroom, 2-bath house that we bought a number of months ago. As I mentioned before, we bought it for $200,000, and we thought we were going to put about $80,000 into the rehab. Rehab's got it expensive since COVID. Very expensive, especially in my market like many of yours. You can tell here the roof is actually a little messed up. It's not the best color. It's what, salmon or something like that? I don't know. But it is just a normal Rambler or Rancher, depending on where you live and what you call it. That's just basically a rectangle house that you can do lots of cool stuff with. There's rot. There's issues. The windows seem okay for the most part, but you can see there's some rot on this T111 siding. The landscaping's not that great, but that's not a big deal. It's not that hard either to be able to fix it all up. It's really not that impressive of a house on the outside. The outside is just plain. It's the normal kind of property that you have in this kind of neighborhood, in this kind of market. That's just been not the best taken care of as far as tenants are concerned. This was a landlord that owned it. He wanted to get rid of it and just walk away. This is a septic system, so that should be a sign too. If you see a big hole and there's a big container in the dirt, you wonder what that's for. The roof's bad. Talked about that already. Some rot. So let's go into the house. It's really just cosmetic for the most part. Now, if you guys remember watching every single HGTV video that's out there, when you have a kitchen and a wall's in between the living room and the kitchen, what do? You knock that wall down. That's what you do, right? To open up the kitchen. Just make sure it's not load bearing. We have this is actually laminate flooring, not hardwood flooring, tile throughout. But for the most part, this is all cosmetic. And I'm going to go through these next photos quickly. The kitchen's bland. Everything's just kind of bland. Yada, yada, yada. No big deal. Oh, this is bad. So this is actually a Federal Pacific panel, right? Yep, sounds right. Which is a bad panel in our neck of the woods. And we always need to replace that. Furnace is an old electric furnace. Water heater is an old electric water heater. Fridge is messed up. We take very thorough photos. Everything in this house is cosmetic. So when I see a property like that is pretty straightforward to us. It's not a big deal. It just is a basic remodel that we need to take advantage of. So we were very excited when we tied up this property for $200,000, and we thought we'd only put about 80 grand into it. With those kind of numbers, we're like, hey, this is going to be a pretty easy flip, right? When we're at the end of the day, it's not going to be that big of a deal. We've done tons of Rambler ranchers like this before. We'll be able to knock it out of the ballpark. We'll probably come under budget on the property, but we had to guess on some things because we didn't have full access to it. And when we're done, we could rent this thing out, get a big, nice refinance, take all our money out and cash flow on it and hopefully get an infinite BRRRR. Even if I had to leave a little bit money into it, it's a great Rambler. We'll cash flow. Everything will be fine. We're probably going to put this property in a portfolio and keep it for years and years and years to come. Boy, was I wrong on that one. So what happened to the market? Well, for those of you guys that aren't well versed, it is May 2022 right now when I'm recording this video. In December 2021, when I bought this property, I could have gotten an interest rate for this property for probably right around like 4% to 4.25% for a DSCR, debt service coverage ratio, asset-based lender. Not a conventional mortgage. I could have gotten a cheaper rate with a conventional mortgage, but when you've invested long enough, you don't always qualify for conventional anymore because you have too many loans. So you go to asset-based lenders or portfolio lenders or your local community bank, and almost every one of those community banks and asset-based lenders and whatnot, DSCR lenders, they're going to look at DSCR, debt service coverage ratio, right? Now, lo and behold, we go and finish this property up in April 2022, and rates are significantly higher than we originally planned. I'm going to go over all those numbers and what that actually means. But first, for most of you, you all like to see what the after photos look like. So let's get into the after photos right now and show you what the beautiful property looked like when we were all done. So there we go. Look, same looking house, but we actually changed the siding on the front. One little trick, especially in certain neighborhoods, and you look at a lot of new builds, they have a nice siding on the front and they have cheap siding on the other three sides, the sides and the back. When we're in really nice neighborhoods, we do all nice siding throughout the entire property. But when we're in a little bit lower end neighborhoods or B class or whatever C class depending where you're at, just areas that you don't need to justify super high end siding, we spruce up the front like most builder grade properties would do. In this case, we put Hardy Lap siding on the front and we left T111 siding along the sides to be able to save some costs. We changed the garage door out a bit. Actually, no, we painted that one. Never mind, I lied. And we did what we said. We opened up that wall and made the kitchen a lot more functional. It was a much more functional kitchen when we were done. We put luxury vinyl planking throughout. We staged the property. If that doesn't give you a hint what we ended up doing with this house. We painted everything. We made it just a clean, nice property. We upgraded all the finishes. It looks very clean. We upgraded some of the electrical. We made it better. We, of course, changed out the cabinets and countertops. We did some tile backsplash. The bathrooms look better. We made a master suite. This used to be a toilet and a vanity and then a closet. So we took out the closet and added a shower to make it a full-on in-suite master suite, right, for the property to add value. We planned on doing that whether it was a rental or whether it was a flip. So we went through the whole property, blah, blah, blah. Looks good, looks clean. Backyard looks the same other than we cut the grass. That's it. What does that mean? We bought a property for $200,000. We thought we were going to spend about $80,000 on the rehab at the end of the day. And believe it or not, we thought we might be able to appraise it for around $425,000, give or take. 400 to 425 was kind of our guess. We thought 425 was a good shot. We were guessing on that one a little bit. We thought the market would go up a little bit, but we felt pretty strong in that neighborhood. We could probably get 425. So those are strong numbers. If you buy a property for 200, rehab it for 80, and then you get 425 on an after repair value, that's a good flip all day long. So I want you guys to remember this. Here's a key pro tip. Every BRRRR must be a good flip first. You hear me? Every BRRRR must be a good flip first. So this is a good flip. Therefore, there's a potential for it to be a good BRRRR. It's already a good flip. We already know that. You know, you buy a property, sell a property for 425 that you only got 280 into it. That sounds pretty good to me, right? But is it a good BRRRR? Now, what dictates it to be a good BRRRR? Because not every good flip is a good BRRRR. So what changes that? So we analyze our deals first to say, is it a good flip? If it is, we're probably going to buy it. And then is it a good BRRRR second? If it's a good BRRRR second, that's the cash flow. Can you refinance the property, get all your money out of it, or most of it, sometimes you can't get all of it, and then still cash flow on the property with a tenant on it, and then some other factors. Is it a property you want to keep? Is it in an area that you like, a neighborhood you want to be in, yada, yada, yada. Those are all things that you got to factor into it. But if it cash flows strong, you got most of your money out of the deal, and you don't need the money out, it's probably worth keeping it, right? That's how you build and think long-term in this industry. So what happened to me? Right from the top again, $200,000 purchase. We ended up spending $88,000 in rehab. Spoiler alert on that one. There's some costs we weren't considering, especially with the septic side. So $200,000, $88,000 in the rehab, $15,000 in holding costs, and we had about another $10,000 in acquisition fees and also points from our lender. You tally all of those numbers up, and we had it out of pocket, $315,000 out of pocket. That's the project cost. All right. So if we have $315,000 project cost, and this property is worth $425 when we go to sell it, there's going to be some selling cost when we sell it if we sold it for $425,000, and that's going to be for us. We have the state of Washington. We have 1.78% excise tax. You also have escrow fees, title insurance, all that great stuff, and then you have your real estate commissions. So we pay a lower real estate commission, and we have some lower fees because we've negotiated that. But our total selling cost is an additional almost $30,000. So we have about $315,000 into the project total, plus another $30,000 in relative costs. If we sold it for $425,000, we would net right around roughly $80,000 net profit if we sold it today for $425,000. So as a flip, that's a great flip, right? Right. Now let's see if it's a great BRRRR, because if you don't sell this project, you only have $315,000 into it, right? Right. And it is also worth about $425,000, which would be great. So let's go into the details, and into the numbers a little bit more exclusively if we kept it as a rental. All right. So we said that we're going to do a debt service coverage ratio loan, DSCR. Now, when we first priced this thing out, we thought we were going to get a 4.25% interest rate. I thought conservatively I'd have 4.25% interest rate back in December when I bought this. Heck, I did a loan for 3.875 in December. So I figured 4.25%, if the rates go up, is safe in a few months. So at a 4.25% interest rate, that would mean my principal and interest, PI, payment would be $1,697. And then if I had taxes and insurance, about $300, my principal, interest, taxes, and insurance would equal $1,997. Now I thought, and we probably could rent for $2,250. So rent's $2,250, and my total out of pocket for my mortgage payment would be $1,997. Now if I don't have property management fees and I don't have vacancy issues and CapEx issues, then my net income would be $253 a month renting this thing out. Great. Now, let's go to another chart here, and we'll spell out, let's say that it did appraise for $425,000. We can get a 75% cash out refi loan to value on $425,000. That would equate to $318,750. That would be the max loan amount. Now, if my total cost into the deal is $315,000, and I can get a loan for $318,750, that would mean the bank would give me roughly, not including closing costs and all that kind of stuff, $3,750 cash out back to me in addition to all my expenses and costs into the deal. That's what we call, big letters here, an infinite BRRRR. All my money out, plus a little bit more, and still cash flow $250 a month. Great freaking deal. And, spoiler alert, still have that almost $100,000 of equity into the deal. Some of you guys might be asking, why would you only cash flow $250? Well, we still have the equity in the deal, right? But what if you don't need that equity? Then you keep it in cash flow and you have no money into it. That's an infinite BRRRR. Great. That's what we wanted to have happen, but it didn't happen. What interest rates were DSCR lenders giving us back in April, last month? Now, there's local community banks that can give a little bit better interest rate depending on where you are. But for investor properties, these are investment properties, investors, commercial lines of credit, that kind of stuff, then the interest rates are pretty high compared to, let's say, primary residence interest rates. A lot of primary resident interest rates are in the 4 and 5s right now. Investment property interest rates are in the 5, 6, and 7s, depending on where you're at and what kind of financing you can get. So we were quoted let's tally this up. We were quoted a 6.5% 30-year fixed loan. Now, we could have gotten a adjustable rate. We could have got a lower interest rate. I don't believe in those right now because the rates aren't going to go down anytime soon. I want to lock in at a 30-year if I can. So let's write that 6.5% 30-year loan, 30YR 30-year loan, right? That would mean my principal and interest payment is $2,181 on that loan, borrowing $315,000 on it. Or sorry, borrowing, roughly $315,000 on it, which is my cost. My taxes and insurance would be $300. So if I rented for $2,250, I'd have a negative monthly net income of $231 a month. That's negative. Now, that's assuming I can get 75% cash out. Well, guess what? Let's talk about what DSCR means, debt service coverage ratio. Debt service coverage ratio. That's a ratio of your net operating income versus your debt on the property. Now, what is NOI? Net operating income. NOI is your gross rents minus all your property expenses except for debt. So that would be your insurance, that would be your taxes. Do you have any maintenance or CapEx or any of that kind of stuff, or even property management fees? Now, we in-house property management, so we don't count that stuff. But that said, if your debt service coverage ratio, what that means is that you take your NOI and you divide it into your debt payment. That's your principal and interest. And if you have $1,000 NOI with $1,000 debt, that's a 1.0 DSCR because it's a 1-to-1 ratio. Now, if I had a $1,250 monthly payment, rent, and $1,000 debt, then I'd have a 1.25 DSCR because that's a 1.25 ratio. Hope that makes sense. Now, why is that so important and why am I drilling down on that? There's a few factors that come into loans when you're dealing with asset-based lenders, DSCR lenders. And that is they're looking at your appraised value, your ARV. In this case, it's $425,000. And they're looking at your gross rents and your net operating income with those gross rents to figure out your DSCR. And they have a minimum DSCR they must meet in order to lend you money. Most lenders today are a 1.1 DSCR or a 1.2 DSCR. So let's say that this lender, which we were going with, was looking for a 1.1 DSCR. What does that mean to our cash out refi? Going back, I said we can get a 75% cash out refi if we had a 4.25% interest rate with a DSCR lender. However, when we have a 6.5% interest rate with a DSCR lender, that messes up our DSCR. I keep saying that acronym, but it's really important to remember, especially in today's market. So let's go to the tally here. So we have $2,250 a month rent. Check. If we borrowed from a lender with a DSCR lender that required a 1.1 DSCR, that would mean the maximum principal and interest payment I can have is right around $1,725 a month. And then you add your principal, your taxes and insurance, and that becomes $2,025 a month in principal, interest, taxes, and insurance. So we have $2,250 in rent. We have a 1.1 DSCR, right? And we also have, so we have a principal and interest of roughly $1,725, and we have taxes and insurance for another $300. Total expense, $2,025 with the principal, interest, taxes, insurance. That is the maximum payment I can have on a DSCR loan. That's a 1-to-1 ratio, give or take. I'm off by a few numbers. If my rents are $2,250 a month. I hope you guys are with me on that. So that's what we're dealing with to get a 1-1 ratio, 1.1 DSCR ratio. So what's my maximum loan amount then? It's not 75% loan to value of the appraised value. It's 65%. Why is that? 65% roughly, 64.7 technically, but 65% roughly of a $425,000 loan appraised value is $275,000 mortgage. So my cash flow, my cash out refi of $315 now went down to $275,000 to meet the DSCR ratio payment, because a $275,000 loan at a 6.5% interest rate is a roughly $2,025 PITI, principal, interest, taxes, and insurance payment, to meet the 1.1 DSCR lender requirements. Oh, that's a lot of math, isn't it? And for some of you guys, I lost you already, right? This isn't as simple in today's market unless you're getting a conventional loan. Conventional lenders look at you only for debt to income ratio and your credit score. Go get those all day. If you're just starting out, you could probably get a conventional lender still, and then you don't need to worry about DSCR. But if you're if you're seasoned, like myself, who's been doing this for a long time, you don't get conventional loans anymore. You have to go to DSCR lenders. So, and if that's the case, and if that's you, you might be watching this saying like, I just went through this, right? Many of us did. We have a higher interest rate now, which then affects our cash out for our total LTV that we can get on a property, which then makes us make us decide, do we keep this property or not? If I only have a $275,000 loan on this property now, well, this isn't an infinite BRRRR anymore. I have to leave pretty much almost $40,000 into this deal and have a negative $231 a month cash flow. Would you leave $40,000 into a deal, and that means out of pocket, and in return your ROI is negative $230 a month? That sounds horrible. Might as well just leave it in the checking account and let inflation destroy you. So that said, what did we do? Well, luckily, every great BRRRR must be a great flip first. Going back to that. Because we bought this wanting it to be a BRRRR, we had to make sure it was a great flip. And because it was a great flip, we had another exit strategy, and we decided to sell this house. And when we sold it, we made roughly $80,000 net profit. So we had to make a decision. Do we leave 40 grand into this deal and get negative $231 a month because interest rates rose so significantly? Or do we sell it and get 80 grand cash out right now, net profit? Do we get 80 grand net profit out of the deal and move on? I bet you can guess which one we did. So if you're in these situations and neither one of those is a good opportunity for you, meaning like, let's say interest rates rose and you bought a bad flip to begin with, you're kind of in a situation where you have to cut bait and run and cut your losses, deal with what is, whatever, get out of your situation. You can't get back in the airplane once you jump out of it. You already own the deal. So in today's market, as rates are going to continue to rise, because they will, we have to deal with what's in front of us. Does that mean that you don't keep rentals? Does that mean you don't buy BRRRRs? Absolutely not. I think today more than ever, we should be focused on the long term in real estate, not the short term. I think right now, more than ever, you should be doing everything you can to try to keep the properties that you have, not sell them. Interest rates will not go down, and again, anytime soon, maybe not in our lifetimes. Who knows? I do know this. If you can lock into a 30-year fixed right now, even at a 5 or 6% interest rate or higher, you're better off than you will be 2, 3, 4 years from now. Trust me on that. This is in a recording, and I believe that fully. So if that's the case, then do everything you can to keep that property, lock it in, right? And think long-term if the numbers make sense to you. In this particular deal, I could take the 80 grand out of this, invest it somewhere else, get a better return than a negative return. In this situation, it was a worse deal for me to keep it. I'm not going to keep a negative cash flowing deal, right? Even though the equity is high, I'm just not going to do it. And because the rents aren't going to go skyrocket anytime soon in this particular house, it'd have to go up another 10% in a short period of time. I'm not betting on that. That doesn't even include property management and maintenance and all other stuff with it. That's just the net. So make those decisions for yourself. If you can keep the property, think long-term and keep it. Trust me on that, your future self is going to thank you. If you can lock into a 30-year fix still, it's not going to get any better. You need to lock in now. If you do an adjustable rate mortgage right now, you're going to regret it later in the future. You're going to have to deal with it in the future. So my name is Tarl Yarber. Not to leave on a negative note, I'm happy I made 80 grand on the deal. I'm going to put that money somewhere else. But make sure you guys comment, like, subscribe on these videos. If you have any comments, go to the bottom. Definitely put them in there. I'll do my best to come back and answer any questions that are in that video. And I hope to see you guys on the next one. Make sure you guys follow BiggerPockets, and I'll see you guys later.